IFF now for 3.5 years after 30 years in the industry. How are you finding the transition?
I'm actually finding it quite fascinating. The whole training process is one that I adopted a little bit while I was working, but now to do it virtually full time and do a whole number of courses every year, I find it actually very, very good fun. The highlight, I think, is really just seeing the difference in people that come on the course. There's a whole host of different levels and different levels of experience that come onto the different courses, which actually makes the courses quite challenging and quite fun. There's clearly lots of scope for people who are limited experience of project finance, haven't seen it, so that they come away with a great deal of learning that comes from the courses. The guys and intermediates pick up a lot because they can then actually see where their experience fits into the whole value chain in terms of project finance. And then where we have people a bit more experienced, every now and again we have to sort of chuck them a little bit more meat, a little bit more red meat to make it a bit more interesting for them. But ultimately, they got the opportunity to really just reinforce their learning, understand the basics again, because sometimes they may not have gone through the basics, just built a lot of experience. But also they've got access to myself, who's been in the industry a long time. I've seen an awful lot of transactions from a different range of perspectives, through the origination and through syndication of project finance deals. And so they've got the ability to come and ask a lot of questions, and invariably, or most of the time, I think I can answer their questions. And if I can't do it straight away, then I'll certainly go away, search both my colleagues and my old contacts in the industry, and try and get an answer for the questions that are thrown at me. So in some way, it's great fun. I'm thoroughly enjoying it, and I hadn't realised quite how hard work training is. Standing up in front of 10, 15 people, being quite animated. I enjoy the subject. I thoroughly enjoy talking about project finance and talking about the experiences I've had. So I was very surprised how weary I am at the end of it, at the end of a day's training. But it's very rewarding, and I do thoroughly enjoy it.
Excellent. And what do you find the most satisfying part of the training?
I think the piece I enjoy the most of all is when you actually see the penny drop. When somebody actually gets something and realises what I'm trying to explain and the processes. A little while ago, one of the courses I was running, I was quite pleased. I've been running through the qualitative issues that we talk about, sponsor, the construction risk, and all those type of areas in the project finance. And I heard somebody whisper to their neighbour, now I understand. And I think that part is something that anyone who's doing training actually thoroughly enjoys, when someone realises and understands what you're trying to get across. And that just makes me smile.
Okay, so over the past few years, what are the biggest changes that you've seen?
Well, I think there's quite a few little changes that happen. A couple of the big things is really the way that the market's changing and the participants within the market. Let me just give you a little bit of colour with that, what I mean by that. In terms of emerging markets, certainly post 2008, the commercial banks have certainly pulled back to some degree from the emerging marketplace. And we've seen a massive increase in the participation of the development finance institutions, particularly in this time zone, the European ones, the FMOs, the PARCOs, the entities that have got a development need to their mandate. Also in the international finance institutions, the likes of the IFC, the African Development Bank, EIB, EBRD, etc., stepping in and putting in a significant amount of liquidity in place into the emerging markets. And also, there's been a little bit of role, quite a bit of role with the export credit agencies as well. Again, putting money in to the emerging markets to support their exports. The different institutions have different drivers, and when you're looking at project finance transactions, it's interesting just to try and understand those separate drivers. And then in the OECD, in the more mature markets, we have a position where insurance companies, infrastructure funds have come into the market very significantly over the past few years, and that's really changed the dynamic to some degree. The other thing is the export credit agencies as well have also come in into the markets a little bit more. With infrastructure funds, there is a slight nuance that goes on with them, and that's really to do with brownfield and greenfield participation. In the brownfield sector, the infrastructure funds play a lot larger role because there's existing assets in place. In greenfield, they need a different experience base, and there's a less participation in greenfield, like building something from scratch. But that's beginning to change a little bit. But that's the major things in terms of the way the market has changed over the past few years in terms of the participations.
So does that mean that banks will soon no longer have a role, or at least their role is diminishing?
I think the strength of the banking market remains extremely robust. The banks have got an awful lot of experience, a lot of competence, and they have the ability to deliver projects. So I think they've got a very strong role to continue to play going forward. They may reduce and reduce their participation in the longer term funding of the assets, making space for the infrastructure funds, etc. But I do think they will continue to have a very strong role. We've seen cycles before, and I'm sure they'll continue to have more cycles, partly to the regulatory positions. But it's actually, they will continue to have a long-term position in the marketplace.
And what are the other changes you've seen?
I think one of the most significant changes we've seen is the incredible growth in renewables. When I actually first started in project finance, far longer ago than I care to remember, the renewables market was a very, very small, tiny segment. In fact, when I first started, renewables didn't really exist. I mean, the market has continued to evolve and change. So when I first got involved, renewables didn't exist. Initially, they came up as a very small niche, dependent on very high subsidies. But the market has an ability to adapt and change. I mean, one of the first deals I actually saw was Teesside. It was a 1,800 megawatt plant that was being built up on the Teesside plant, which was a combined heat and power plant. It was actually led by a name that is not mentioned in polite circles anymore. It's led by Enron, and some of the older PF bankers will certainly remember that name. And it's certainly a good example for perhaps some newer participants in the market, just to see how not to do things, maybe. But that plant was built in '93, and when that came out, we were all learning the new phases of heat rate, etc., and how gas turbines actually operated. So we learned how that came into place. We then looked at the dash for gas in the UK and how new gas-fired plants were built. We also then saw some degree of problems in the market where we had a change of the regulatory systems with the introduction of NETA, and banks actually ended up owning power stations. Mm-hmm. So we've seen ownership. Banks get scared when they own power plants, but it was quite a learning exercise. So the banking market has the ability to adapt and learn, and the position of renewables has meant that we've all had to learn a significant amount over the past 20, 30 years in terms of project finance. But the position of renewables now has really pushed the thermal plants out of the equation. And everyone that used to be a thermal banker is now very much a renewable banker looking at the renewable sector. But the evolution and change in that market has been absolutely tremendous. We've gone from very, very high subsidies down to now zero subsidies, auction processes, and we may actually come back to looking at merchant plant, which if anyone's got a little bit of older memory in terms of some of the deals that were done in the past, it will be certainly a challenge, and we look at and discuss some of those issues on the courses that we run. And there's a massive amount of change that's coming that's driven by renewables. Not only have we got the offshore wind farms, the solar PV, etc. There's also going to be a massive amount of change to the electricity system, the industry, driven by renewables, driven by changes in demand management, and driven by general decarbonisation. And so we certainly expect there's more change in the power industry that we've had over the past 5-10 years anyway, but there's much more going to occur over the next 10 to 15 years, far more than we've seen over the past 150 years. So there's an awful lot that's going to happen. And I must admit, every time I run a course, the interaction that we have, because I encourage a huge amount of interaction with the participants, I come away having learned a lot more, having run every single course I do. My wife's a teacher, and she comes around and tells me that every day is a learning day. And I certainly find that when I run some of these courses. And then the other thing I'd like to mention a little bit in terms of changes is we talk a lot about how deals are structured based by the fundamentals of the transaction. And that's great. And we run through a huge amount of the building blocks on all of the courses. But one of the key things to remember in terms of how deals are structured, and that's the impact of competition. And at the moment, there is still a lot of money flying around. As mentioned, we've got the infrastructure funds, the pension funds, etc. coming in. So there's lots of cash flying around. And if you think about it, if you've got €1 billion project and you actually have €2 billion of cash chasing it, there's a very strong competitive element to it. So the sponsors will keep pushing away at each individual lender, just at the margin, well, not really on the pricing margin, but on the margin of the terms and conditions, extend the tenor a little bit, reduce the cover ratios, be more aggressive on the structuring. And so the amount of competition in the marketplace, I think, has as much an effect on some of the deals and how they're structured. And I bring that out on some of the courses because we talk about some toll roads that have been done in Germany that have been extremely aggressively structured, but now are ending up in a significant amount of distress. But the amount of structuring and the position of it was driven by competition. So we're in a very benign scenario for sponsors, and I think my career's seen 2 or 3 cycles of pricing and structure. So it'd be interesting to see how long this actual cycle lasts, and when it turns, how ready the lenders are and sponsors are for a tighter environment.